All right. Hello, everybody, and welcome to our Facebook Live and our podcast. So if you listen to our podcast, thank you for listening. If you are with us live on this Facebook Live, thank you for being with us. And if you have questions, please put it to the comments. If you listen to the podcast, there's a comment section at www.ieapodcast.com. You can leave a comment next to the podcast that you're listening to, and as we can, we will get back to you. So you might have read the title and thought, okay, why can't I retire on time? You might want to stick around to find that out. And a lot of you all think, oh, I know exactly when I'm retiring. This might be a very eye-opening Facebook Live, and I think this is one you probably want to share with some people that you know, because you might want to have this water cooler talk later on when you're back in the office. So while Leon tells you why we actually chose this topic today, I'm going to do what I always do, a little bit of housekeeping.
Yeah, so topic today, so just take a step back. One of IEA, Brent and I and IEA's main pillars that we live by, and that IEA is built on, that Brent and I believe money is essentially built on, is to, and everyone that follows us, our podcast, inside our community, Facebook, or our membership platform, I've heard us say a million times, and you can hear us say it again tonight, but a million times, your money should never be sitting in a savings account. Should always be sitting in an asset that's earning at least more than inflation. Now, everyone that follows us kind of knows that. But the interesting thing is that for anyone who's been following us and thought, they always say that, but doesn't really affect me, or maybe those guys don't know what they're talking about, or it's not that big of a deal, right?
I hope they're not saying that.
Hey, I mean, you never know,
because we are a year into this. So at this point, I'm guessing you all believe we have a reasonable understanding of the market.
I would hope that's the case, yes. But so what we're going to show you today is that, I was doing my usual research, and I came across an article. It was about a guy named Larry Fink, and Larry Fink is the head of BlackRock. Brent, if you could throw up slide one, when you a sec.
Yep.
So Larry Fink is the head of BlackRock. Now, the reason I found this to be very, very important to bring this up, and why it resonated with me, is because the company that Larry Fink is CEO of, BlackRock. I mean, so I'm about to give you some stats that are just mind blowing. So like I said, Larry Fink is the head of BlackRock. BlackRock is the largest by far. Like, it's not even close. The largest money management firm on the planet. Now, what we have up here, slide one, on the right of your screen. So what we have up here is a slide of Larry Fink, and then a stock chart of BlackRock's when he was on CNBC recently. So that's Larry Fink. So Larry Fink, again, is head of BlackRock, the largest by far money management firm on the planet. The ticker symbol is BLK, if anyone wants to look them up. And the reason the article I read was important, so let me just give you some stats behind what BlackRock does. So BlackRock manages, listen carefully, BlackRock has under management $9.49 trillion, with a T, trillion dollars under management. Last year, between last year and this year, last year at this time, they were managing 7.32 trillion. So just in 1 year, they've increased their money under management by $2 trillion. That's larger than some countries' economies.
A lot of countries'
economies, right? They took in just 1 year, $2 trillion that brought them up to $9.49 trillion they have under management. So that's one. So they're the largest money management on the planet, on the face of the earth. To put that in contrast, think about this. The U.S. economy is a $21 trillion economy. So think about that. BlackRock, just a single company, the amount of money they have under management is roughly half of what the entire U.S. economy is. That is absolutely mind-boggling that one company manages that much money. To show another piece of their cred is that the Federal Reserve, the big Fed, they control interest rates, they control monetary policy, and they control a lot of things we do, loans, credit cards, things like that. The Federal Reserve, they hired BlackRock to help them implement their stimulus programs and packages to keep the economy going during COVID. So they hired BlackRock to help them implement, design, put together these different packages that would help banks, that would help insurers, that would help us, to keep afloat during the pandemic. So again, that shows you how just influential BlackRock is. So that's BlackRock. So BlackRock, again, by far the largest money manager on the planet. They have, like Larry Fink has forgotten more about money than most of us will ever even learn. Like he is just a straight up G. And the company that he manages, that he's head of, again, manages $9.49 trillion. They have that much money in their management. So that's the introduction to BlackRock and who Larry Fink is. So Brittany, if you can go to slide 2. Now, slide 2 is gonna now talk about kind of what Brent and I always talk about. And the reason this is really, really interesting to me is Larry Fink is preaching. I mean, he almost said it verbatim. The same exact thing that Brent and I have always said from day one is money should never, ever, ever be sitting in a savings account. And it should be in assets that are beating inflation or that are, most likely the stock market is his main thing. But that money should never, ever, ever be sitting in a savings account. So I'm going to read you. So we have a new slide up here. He actually introduced this terminology or this phrase called silent crisis of retirement. So Brent and I always talk about
this is good.
Brent and I always talk about getting your money out of a savings account, putting it into an asset that's going to earn you a return higher than inflation. We always talk about this from the standpoint of you want to grow your money, generational wealth, pass it on to your kids, things like that, right? He brought up a good point. I never thought about this. He calls it the silent crisis of retirement. So I'm gonna read you. So on the slide we have on the screen, it's I don't know what five or six bullet points. And I'm just gonna walk through each one. So the first few are going to be quotes from Larry Fink. So what he said was, unquestionably, as central banks keep rates low or negative, like they are in Europe, savers are getting slammed. So what is he saying? He's saying anyone that has their money in savings assets, CDs, savings accounts, things like that, are getting slammed because central banks are keeping rates low. Remember, in this country, the average interest rate is 0.05%. 0.05%. And you see why that's how money's just being decimated in a minute. The second thing he says is people may have to work longer because they're not earning the same returns on their savings. He's talking about that they were, a couple of years ago. So
real quick, on that note, for those that aren't working longer, many of the people that fall into that category who are in safe savings accounts, you're going to either work longer or you're going to have a poor quality of retirement. And it's not to say you're going to be destitute, but whatever level you thought you were going to be at retirement, if you're not properly investing, not saving, if you're not properly investing your money, basically, if you're getting your money and you're going to the bank to put it into a savings account, your retirement, you're jeopardizing your retirement. And for those of you all who think, oh, well, I don't want to pay a money manager, or I don't want to pay anybody to help me with my money, because if I don't pay anybody, I'm saving money. No, that is wrong. And I mean, the reality is, even with IEA, honestly, any time you listen to this or if you're on a podcast, please visit our lives every Wednesday at 9:00 and just ask somebody on the thread who's a member how they did last year. And we can't control who you ask. Ask them how they did last year. Ask them what the difference was between what they done as a result of just being in the Investing Education Academy ecosystem versus what they were doing in the bank before they met us. I promise you, the amount that they paid for their membership, they've gotten 10 or more times over since they became a member. And a lot of people is far more than that, but I'm going safe. So just understand, even if you're not working longer to get to retirement, there's a high probability your quality of life is going to be greatly jeopardized if you are just taking your money and going to a bank and looking at CDs or Series E, EE, H bonds, or certificates of deposit of what CDs are, in case you don't know. And they lock in your money at a particular rate over a given period of time until it matures and you can actually liquidate the investment. It really is only suitable for a very select group of people and is normally the uber wealthy.
Yep. And just go kind of back to point 2. Like you said, many have to work longer because they're not earning the same returns on their savings. So again, rates, and he said in the first bullet, is that central banks have dropped rates to basically zero. So as he said, savers are getting slammed. Their money is getting crushed by being in these savings accounts. Now here's the thing. I mean, I don't know how deep people are doing the retirement, if they're running spreadsheets, if they're running, any sort of calculation on their money. But if you're not taking into account, like if you're just sitting there saying, okay, you make X amount per year and you're putting away X amount per year. So that means in the next 20, 30 years, you're going to have X amount of dollars. If you don't take into account inflation and your interest rate on your money, that number is going to be way off. So if you're just saying, okay, I'm putting away 20 grand a year for the next 30 years, whatever that number is, I mean math right now. But if you're saying you're expecting to have $500,000 by retirement, but you're not taking into account inflation and interest rates, you may have $500,000 at that retirement in absolute dollars, but that $500,000 probably maybe only able to buy maybe $200,000 worth of goods, because inflation is going to eat away at that money. So you have to take into account big time your the interest rate you're getting, and then the inflation rate over the between now and when you're going to retire. Estimated out a couple of years to really get an accurate number. Because again, if you expect that $500,000 of retirement, okay, you may have that cash, but you won't be able to buy $500,000 worth of goods, because inflation is going to eat away at the buying power of that money. And to give an example of that, so like you said, like Finn said, basically a lot of people are going to have to work longer, most likely, because they have their money in savings accounts, and they're getting slammed, as he said, based on interest rates. Now, bullet 3, the consumer price index that came out either this week or last week showed, check this out, inflation last year rose 5.4%. Now, many of you heard me say time and time again, inflation is typically anywhere from 2 to 3%, right? Inflation last year was more than double what it typically is. It was 5.4% last year, and let's say typically it's 2.5%. So inflation was more than double, right? So what does that mean for us? So last year, so goods last year that cost $100,000 today would cost $105,000, $105,400, right? Because again, inflation went up by 5.4%. So your $100,000 that you had, say you want to buy a house last year for $100,000, that house today is going to cost $105,400. So your $100,000 sitting in your account right now that you're so proud of, you can no longer buy that house that you would buy last year, right? And I mean, it's reality. Like, we all like to see it in our account, see that big number. But if that big number can't actually buy you what you think, it's not worth as much, right? And so the next bullet says $100,000 in savings accounts over the last year lost $5,400, because again, inflation went up by 5.4% on 100 grand. That means your buying power dropped by $5,400. Hence, that $100,000 house you could buy last year that today is $105,000, you can no longer afford, because again, inflation it way ahead.
Yeah, for everybody watching, and this is a great time to share this with a family member, a friend. We've met people who have millions of dollars in savings accounts and the such. We've met people who have $4 in savings because everything's invested. We've met people who have a couple thousand. I mean, we've met people at all levels. So this isn't intended to really take shots at anybody in particular, but it is intended to raise the alarm, like make it as loud as possible. If you're in our ecosystem, we're telling you this because we're trying to save your retirement, not just because we want you to join Investing Education Academy. We are growing regardless. And so, I mean, the people that do join, I'm thrilled, and we bring them deeper into our ecosystem, and we give them far more information than just the live with this podcast. But we're still saying, if you do nothing else but listen to this podcast, I mean, move to action. We are trying to sound the alarm. Most of these lives and these podcasts that we do, it's a lot we could be doing tonight. It is a lot we could be doing tonight.
It's a lot we could be doing every Wednesday night at 9.
We do this because we really want people to listen, get the message. And we know, like, not everybody's mentally there. Like, people feel comfortable. I've always had a savings account. My parents told me to have a savings account. My parents had a savings account. Only thing I know is this savings account, and at work, they gave me some retirement funds. And they told me that retirement account, by the time I reach 65, because I have a target date fund, and for anybody who works a 401k, where they have a 401k, 403b, 457 plan, TSP, you may have seen those accounts that say target date 2060. That's the date in which you're telling your job that you're going to retire. And what they do is they take everybody and push them into the same investment who picked that same date as you. And normally you can only pick like 2060, 2070, 2080. It's not as if you can pick your date. You can pick a date that they already have, and they'll treat you like everybody else in that group. And then we also have that second group of people who they check in with us. They know they should do something, but they fall into that lull of, but I'm familiar with the savings account. I get it. And right now I'm talking to the emotional side of individuals who are doing this. Leon and I have also said this, we don't care who you work with, but if your majority of your savings is being done in a savings account, and I actually not compared to what you're doing at work, because sometimes about what you're doing at work is by default, but where you choose to put your money. So excluding work, if the majority of your savings is in a savings account, you are losing. And we are trying to save you. It's that simple. It is that simple. And we don't care if you do it with us, with somebody else. Find a professional. Take some money from wherever your money is and pay somebody who's qualified and who cares, who can help you get out of the pitfall. Because I'm telling you, whatever you spend right now, it's going to be pennies compared to what you're going to lose if you stay where you are. And you will lose. And so...
Yeah, this is in no way meant to belittle anybody and how much money they have. What we're saying is that $100,000 you theoretically $100,000 you have in your savings account, which again you should be proud of, right? But you shouldn't worship that money. That money you should look at as a way to work for you and your family. If it's just sitting there, not earning any return, you're losing money every day. And as I just said, inflation last year was up 5.4%. If you were trying to, again, buy the $100,000 house last year, this year you cannot buy it. Your $100,000 lost $5,400 in buying power. And you didn't do anything. It just sat in your account. And this is why Larry Fink called the silent crisis of retirement. Is because when most of us put our money into the savings account, we forget about it, right? It goes away. It's out of mind. It's out of sight, out of mind, right? It's silent. It's in the background, supposedly working for us. But in the savings account, it is not even.
It's like carbon monoxide.
Yeah, like a silent killer. You have no idea it's there. But all of a sudden, it slaps you in the back of your head, and you're passed out in your home, right? Same thing happened to your money sitting in the savings account. With again, inflation was up in 1 year more than double, typically 5.4%. And I had it on here before, but I took it off because it wasn't really accurate. But basically, what I said was, think about taking $100,000. It's almost like you lost $5,400. So you take your $100,000 down to what is that? 96 math? What 94? 94.6?
Yeah, 94.
Something like that. Yeah. So it's almost like your $100,000 got reduced down to $94,600. It's not really accurate because you actually didn't lose any money. So I changed it to that. If you try to buy a $100,000 house last year, that house is now worth $105,000, and you can no longer afford it with your $100,000. But another way you can think about it is also like think about it just like this. Like say inflation was up 5%. It's almost like thinking about your $100,000 lost $5,000. So your $100,000 is like down to $95,000. Because you lost that buying power. You can no longer buy $100,000 worth of goods because inflation just crushed $5,000 out of your account like that. And you did nothing. You could be living your life and inflation is still going to crush your money. And this is why Larry Fink calls it the silent crisis of retirement, because a lot of people don't know this, right? People feel safe in CDs and in savings accounts, but it's silently killing your money. When I saw
this is a good time for me to do this.
Right, exactly. Yeah. Everyone in the IEA knows what that shirt are experiencing that shirt.
Right.
But 5.4% rate of inflation last year, just in 1 year, is devastating. And so we just hope that everyone really, really takes this live and this message to heart. With somebody like Larry Fink, who has the biggest money management firm on the planet, is singing the same tune that we are. We kind of take it as a badge of honor, but we hope that, like I said, maybe we were just singing tunes or whatever. You really weren't paying attention. I hope that you pay attention to a man and a company that manages $9.4 trillion and grew that money under management by $2 trillion last year. And he's saying the exact same thing we are. Your money is being, as he said, you're being slammed by having your money in a savings account. And the last bullet, he's saying that he's finally seeing people are now actually moving their money out of savings accounts into things like the stock market, because they're now seeing that they're getting no return, that inflation is killing their money in their savings account. So money is being moved out of that at a savings account in the stock market. That's one thing that us at IA is one of our main objectives is to get people to do that. So move their money out of these very, very low risk, essentially money losing investments into things like the stock market, which again, you're going to get an average of 10% per year.
Yeah, and you know what? Even when you look at the CPI, it really doesn't take into account actual inflation. And when I say actual inflation, like go to a store, and anybody who's done anything with home goods and taking a trip to Home Depot, last year, a 6-foot 2x4 was like $2.40. You can go to Home Depot tomorrow, Google it if you want to see if this is accurate. Like that same 2x4, 6 foot long, roughly, is probably about $5.20 now. Eggs since the pandemic have almost doubled in price. It's like almost talking about 100% increase in price of eggs. These are things that you're not. It's not the real, like CPI is cool, but I mean, go to a grocery store and actually pull a bill from last year and pull a bill from this year, and you will see the difference in prices. That's not even accounted for here.
Yeah, the CPI. Yeah, it's a good point. So the CPI, if you think about an ETF that we talked about a lot before, if the ETF returns say 15% in a year, but a lot of the stocks inside the ETF will be up 20, 30, 40%, and a lot of stocks inside the ETF will be down 10, 20, 30%. Right. So the ETF will kind of average out. Same thing with the CPI. Yeah, as Brent said, the 2x4 probably has doubled in price, right? But there are also some goods that have reduced in price too. So but over time, and the average comes out to be about 5.4% on average for how much prices have increased in the economy. But yeah, that's a good point. Actually, I mean, if you go, like Brent said, if you go buy bread, milk, general groceries,
just go buy the staples.
Yeah, buy staples, you'll see things are up 20, 30, 40, 50%, sometimes 100%. So the CPI is giving you kind of an average of all goods, right? Of all goods, 5.4%. But things are we all know inflation is way higher. Real, like Brett said, real inflation is way higher than that. Yeah. So if you think about that, that $100,000 house you want to buy last year could today, or whatever the asset is, $100,000 asset you want to buy last year, today could be worth $130,000, $140,000. So your $100,000 is nowhere near enough to buy goods today that you could have bought last year.
Yeah, and then for those of you all who will think my house is my biggest piece of my biggest investment, and your house is appreciating, how fast is your house really appreciating? Because your house may be appreciating. Let's say you bought it for $300,000, and if you went to sell it, you sell it for $500,000. The likelihood of you like buying back into a $200,000 house is highly unlikely. I know a lot of us like to think, we're gonna go downsize in retirement. It doesn't work that way. Normally, when you retire, you want to spend time with the family, you want to travel, you want to do all these things you've never done before. And let's just look at it from a common sense approach. There was 8 hours every day where you had to be at work. 10 hours if you include the commute there and back. If you're not commuting, let's say 9 hours for mental preparation before and the cool down after. You now have about 9 hours where you are literally bored and trying to figure out what to fill that space with. More than likely, you're not going to fill that space with free stuff. You're going to either go shopping, you're going to travel, you're going to do some type of activity. You're going to drive more. And I don't care if your vehicle is electric or gas, its power costs money, however you play it out. So this just common sense. When you go to retirement, and if this doesn't make sense to anybody, please contact me, send me a direct message, and I would love to talk to you about it. The 8 to 10 hours that you spend every day, you have to fill that time now. You are not going to fill that time with just an activity that requires you just to read, or not for the whole 10 hours. Maybe some of it, but not the whole thing. So anyway, the point is, when you get to retirement, your expenses really do go up. And so many people miss that. And then they have kids getting married. They have grandkids they want to do things for. And it all costs money. And again, for those of you who think my house is my biggest investment, if you were to sell your house tomorrow, would you move into a lesser house? Some of you all, the answer is yes. But how much lesser? Because the $500,000 or $2 million that you sell your house for may not buy you the 1.8 house that's down the street because it's a bidding war on it. So now you just move from here over there. So it's essentially the same thing as refinancing your loan. So anyway, that's a whole nother thing. But I do know sometimes people get on this kick where they think, oh, well, my house is my biggest asset. And sometimes it's a liability. It's just your biggest liability. And when you go to sell it, the money you thought you were going to use to buy another house, you can't afford the house you really want. And now you're sitting there scratching your head thinking, oh, I guess I didn't plan this the right way. And we are trying to stop that here.
Yeah, and on that house point, which is a good point. So the reason why one of the reasons why home prices are appreciating so much is kind of the point Brent said. People have crazy amount of equity in their homes, right? $300,000, $400,000, $500,000 in equity. But like Brent said, problem is if you sell your house and you pull out, you net 250,000, which we all think is a lot of money, right? Problem is, like Brent said, you cannot find it's very hard to find a home for 250,000, for maybe even three, maybe even double it. Maybe hard to find a home depending where you live for double that, for $500,000. So what's happening is people that have all this equity in their home, they're actually not selling their home. And the reason they're not selling their home because they cannot afford another home, a comparable home or a home. Most people sometimes want to upgrade or just, step up a little bit. They can't afford it, right? So they're saying, well, let's wait for the market to cool down. So they're going to sit in their home longer, which what does that do? That reduces inventory. And for people that were moving around a lot because of the pandemic, they're like Brent said, bidding war, and they're driving the prices up. So the inventory of homes is actually a lot less because while people have a lot of equity, they know if they sell the home they want to buy, they cannot afford. And that's inflation. Again, that's inflation. That right there shows if you sold your home for 250 grand, you profited that. But the home you wanted to buy now is $400,000, $500,000, $600,000 that maybe last year was around 250 or 300. That's a perfect sign of inflation and why it's keeping people in their homes and they're not selling because they can't afford it because the price of homes have shot up.
And Leon, since we're unwrapping that a little bit, let's go another step further. Now you're in your house, you're a saver, so your money's safe in this savings account, and you're staying in your home because it's your biggest asset. Who are you competing with when you go to buy a new home? You're competing with the investors whose money is actually working for them. So they can afford, in some cases, not all, they can afford to go a little further in that bidding war than maybe a person who's exclusively a saver. So especially, it's some places around the world that like whole sections are cryptocurrency investors, like entire sections of real estate. And I promise you, when these people moved in, they didn't care about the price because they didn't have the emotional attachment to the money like a person that worked 40 years for their money does. They invested, and it's literally a different emotional attachment to money. That's who you're competing with when you go out to the open market, especially if you're trying to step up. So, just understand you're not competing just against everybody else who's a saver. You're competing against those people who the house was just an additional asset. It wasn't the only asset. And so one of the questions came up, am I saying that target date funds are bad? I will never say that. I will never say exclusively they're all bad. I'm gonna say I would never do it. I also say, if you have a target date fund, again, let's just look at the rationale behind it. If you go into your job, and this is for anybody listening, and you sit down with your HR director, the company's financial advisor, who is licensed, and more than likely his or her greatest concern is not getting sued, not necessarily how much your money grows. It's their commission and not putting the company into a position to get sued. Those are two biggest motivations for most licensed financial advisors. And I'm speaking about this. I was a licensed financial advisor for over 20 years. Again, if there are any advisors listening to this and you want to send me a direct message, happy to talk about it. Now, with that being said, they slide some options on a booklet across the table to you, or you go online and they say, pick which one, you pick your asset allocation. That's what they say. Most people freak out when they go to pick out, like they see all those boxes, they see all these numbers. It's talking about 12B1 costs and CDSC fees and annual returns, 5-year return, 30-year moving average. Like their mind just starts moving. They're like, oh, I don't want to do this. And they're like, oh, well, if you don't want to pick individual funds, you can actually pick one of these target date funds and just tell us what date do you think you're going to retire? And you say 2050. They go, okay, and they check a box, and that's it. Does that sound like somebody that prudently thought about your situation? And honestly, if you ask most of the investors, and I would actually challenge people who are listening to this podcast or watching us live, when you sit down with your financial advisor at your company who oversees that particular selection of mutual funds and the such, ask them what's in the target date fund. And if somebody gives you an answer, please inbox me and I will do a public apology, because I'm guessing 90% or more. Really, I think it's 99, but I'm saying 90 to give myself some margin of error. 90% of the financial advisors that you ask who manage that company's portfolio for retirement will not know what's in your target date fund.
And I'd say I'd add another question, not even ask what's in it, but ask the allocation of it.
That's what I mean when I say what's in it.
You mean the allocation. Okay.
Like, what's the allocate? Like, and so what are the what is this target date fund invested in? And if they throw things around like, oh, well, let's mix between growth stocks, some capital appreciation stocks, some small caps, some international, yeah, that sounds great. That's not answering the question. So don't be bamboozled. That's not an answer to the question. Like, what is in it? Not what could be in it. Not what does it consist of. What's in my target date fund? They probably cannot answer that.
Right. Yep. Mm-hmm. Yeah. No. Agreed. And that's, I mean, and it comes back to, again, like Larry Fink is saying, silent crisis of retirement. When you blindly just put your money into things like that and you have no idea what's in it, you have no idea if it's beating inflation. You have no idea if it's beating the stock market. I mean, I looked at the other day. I mean, we're at 40 minutes. I know we could go on forever, but just real quick, one of the biggest things out here now are robo advisors. And my God, I looked up their returns. Robo advisors have been around, I don't know, maybe 8 to 10 years, between the last 10 years. Their returns are putrid. The stock market, you can blindly go buy SPY, which is buying the S&P 500. You'll get 10% per year on average on that. Yo, target date funds. Sorry, robo advisors.
Robo investors.
Yeah, sorry, robo investors. Robo investors. The average return was between like 2.5% to 4%. The average return did not break 5%. The stock market by itself returned 10% on average per year. So, I mean, this stuff just blows my mind when they say, "Oh, robo advisors sounds very techy and very advanced," but their returns are terrible. And a lot of people, again, don't know what these robo advisors are buying. Just like a lot of people don't know what target date funds are buying. Yeah. So that's why we're always saying, look, you got to know what you're buying. You got to know what you're investing in. You got to know your return, at least the historical return on your money, because you should not be putting your money in something that's returning you 2.5% when you can throw a dart. I mean, at any ETF list and get damn near 10% out of that. So
okay. So we're not suggesting throwing darts at
no, not suggesting it. Not saying, but my I just could not believe robo advisors' returns were that bad, were that terrible.
And robo advisors are really their popularity is coming into vogue with many of these apps that people are just downloading, and they're like blindly like, oh, I'm investing now. What are you investing in? I have a robo advisor, and they're just buying stuff, and they feel better because they're doing something, but it's like the bare minimum. And also too, I'll say this. It's hard to break from comfort in those things that are familiar. And so we get it, which is why we're saying this so much. If anybody's listening, Leon and I don't ask for much during these podcasts. Like,
right.
I mean, if you join, cool. If you don't, cool. Like, but we really just want people to change, because I don't know, one day you might hire my daughter, or, you might be working with somebody in my family. And I hope if we can touch enough people with good, valuable information, we're going to change our ecosystem. So now when the world really opens up and we start launching our retreats and, having our conferences, we want people coming to our conferences like ready. Like, we already know, we did these things. We've seen the results. Now what's next? How do we crank this thing up? Because, I mean, right now, again, if you are at work, if you are working a job that gives you a retirement account, this is what everybody. If you are working a job that gives you a retirement account and you haven't looked at your retirement in a year, then I would guess that you haven't looked at your retirement in the last 2 years. And if you haven't looked at your retirement in the last 2 years, there's a high probability you left a job that gave you a 401k, a 403b, a 457, a 412i, a 418 plan, and you forgot it was there. And it is still there. And they are just using your money to do other things. And you're like, oh my gosh, I totally forgot that I quit or got fired or whatever. And I never moved that money from that last company.
And they're being charged annual fees on it.
Yeah. And I will say this though, the fees on most job sponsored 401ks are nominal to the end user, being the employee, because normally the job assumes most of the cost in those, but still it's a fee.
It's a fee, right? Yeah. Why pay a fee? Why pay a fee you do not have to pay? Right.
And you're paying a fee for an inferior product. That's the thing that means.
Right.
Like,
it's not coming anywhere near to the market returns, and you're paying fees on it. Yeah. So yeah, it's crazy.
And I'm gonna tell you personally, I've helped one person, and more than that, but one person recently moved their stuff from their old retirement account. They, with a little guidance, did more in 2 years than they did in the last 21 years where they were working. 21 years. They did more in the last 2 years managing their own money than what they did in the last 21 years at the job they were working at.
And that money,
they thought it was never possible.
Yeah, and that money that was at the job is supposedly quote unquote professionally managed, but they themselves, when they managed themselves, did way better than that 21 years of being professionally managed. So
I mean, they got some guidance, but they chose.
They got guidance. Yeah, but that just showed you that the quote unquote professional managers, their interest is not in you making money. Their interest is the fees that you're paying, that they're paying, that their products are putting you is paying their company, which in turn, they of course pays their salary. So.
And it's not all financial advisors. So I want to make sure everybody understands. And I was a licensed financial advisor for 19 years, so I'm definitely not bashing. But I will say, as a fact, many of the financial advisors in the world, they go to a company, and that company teaches them the right way to be a financial advisor, and they never had any real life experience. Many of which don't even invest in the stock market themselves. And they're trying to sell you on all these things that they have never owned for more than 10 years. And you don't have the historical understanding in most cases to truly sell somebody on something else. You just don't have the experience. And what you read half the time is just stuff they give you. So you leave thinking, oh, I know exactly what I'm doing. And you really don't know what in the heck you know.
I mean, so last point of this, because we're drilling home.
You're emotional.
Yeah, Brent was a licensed advisor for 20 years. I've never been a licensed advisor. Everything I've learned trial and error on my own. So I've had professional licensed advisors call me for advice. Call me. I've never been licensed in my life. Now, do I know how to manage money? Yes. Do I know how to invest in the stock market? Yes. Am I successful at it? Yes. So when I have licensed professionals call me for advice, that really you got to call into question, and like Brent said, when they're hired, they're taught to sell certain products from that company. They're not taught how to invest. Their goal is to sell products of the company they work for, not to grow your money. So that was just eye-opening to me when I had professional advisors who were paid to advise calling me for advice. It was crazy. But all right, so to wrap it all up, to bring this home, we kind of harped on this subject today because, again, it's one of our pillars. Please get your money out of savings, put into something in essence going to earn you more than inflation. But to hear somebody like Larry Fink, who heads the largest money management firm on the planet at $9.49 trillion that they manage, which is half the U.S. economy, to hear him sing the same tune that Brent and I have been saying for the past year and a half since we started IA, and we lived it before. But one of our main pillars of get your money out of assets that are paying or earning you less than inflation, to hear him say it and say it in so many terms like savers are getting slammed. I loved it. I loved it. I was excited to read it that he thinks the same. Our mentality is the same, along the same lines of a guy who managed $9.4 trillion. So we just want to show everyone that it's not just our way of thinking. It's also many big wigs on Wall Street that they're thinking the same way.
And for everybody who is with us and stuck with us and you're like, oh, that's a pretty cool shirt. And for those of you who are listening to the podcast, you can go to YouTube and search Investing Education Academy and see the shirt we're talking about. It's our 1-year anniversary shirt. As you can see, we have a plethora of them. We will be distributing them to some of the members in our Invest in Education Academy platform as a sign of appreciation for some of the things they've done. And, you know, right now we're in that whole growth cycle. And one of the things we put on here is our money is earning more than yours. And we did it to really jolt people into like, what does that mean? What are you trying to say? Our goal is really to shock people, not shock, just to move people into a direction where they want to do more with their money. They want to have their money actually working for them and not have the mentality, the only thing I can do is work for money. That's not the way it should be. It's not the way it has to be. You are choosing it if you are just keeping your money in the savings account. It is a choice. In 10, 20 years from now, it is truly my desire that Leon and I won't be in some place in Dubai at a 20th, 100,000 story of some building doing these lives by ourselves because nobody else, well, we already know there are people riding with us, but you know, we just want as many people as possible to be in that ride with us, you know, when we start traveling the world, doing these discussions about financial literacy. So, you know, with that being said, thank you for being with us. Thank you for listening to the podcast. The podcast link is in the description above. And if you do have questions, I think we answered all the questions that we got today. But, you know, thank you for engaging us. Thank you for the comments. And we look forward to seeing you inside of IEA members platform. And if you want, you can search Investing Education Academy on Facebook and join our Facebook group. And hopefully from there, you'll matriculate into our paid community because there's a lot more information there. And honestly, at some point, you're going to have to pay somebody for the information you need to progress in life. And it's just the reality where we are. And the same way Leon and our investors, we understand business too. All of our fees are really low. So pretty much anybody could join. But there is a fee because we need to grow this as a business so we can touch more people. So that is the reason. I've had somebody ask, well, why do you all charge a membership fee? Why would somebody teach you how to make money and not make money during the process? That doesn't make sense to me. Like, so.
Yeah, and like you said, our rates are really, really low. We did that purposely because we want to have as many people come on board, especially in the, you know, the African American people of color community, particularly because we definitely, you know, we know everything that's going on right now in the country and the world. We want to help lift our community, everyone in general, but definitely our community kind of out of the financial rut we've been in for the past 60 years.
Yeah.
So that's, you know, it's one of our main reasons too.
And to that end, if you go to www.ieanow.com, you will see for the next very short period of time, we have membership offerings that have been cut 20%, in some cases 50%, to, you know, show our appreciation during our 1-year anniversary. And so once you become a member, you're locked in that price. So even after the anniversary sale is over, that is your price for the life of your membership with Investing Education Academy. It's not just an entry price. So if you've been thinking about it, if you've been on the fence, go to www.ieanow.com. Check. We have, you know, again, discounts ranging from 20 to 50%. Take advantage of it. You're locked in for life, and we look forward to seeing you inside the community.
Hey, remember our picks.
Yes, as normal, you can go over to our Facebook group and you can find our 2 stock picks. So we owe you 2 stock picks. So you can go over to our Facebook group and again, search Investing Education Academy on Facebook. You should find us, and we will be happy to show you what our stock picks for today are. You definitely want to know so we can all grow our portfolios.
Definitely.
All right, everybody have a beautiful day.